Welcome to our deep dive into the world of investing.
Okay.
We're cracking open a classic today, A Random Walk Down Wall Street
Oh, yeah.
by Burton G. Malkiel.
Uh-huh.
This book's been a guiding light for millions of investors, and for good reason.
Yeah.
It cuts through all the Wall Street jargon to deliver timeless wisdom that's relevant to anyone,
Right.
from seasoned pros to those just dipping their toes into the market.
Absolutely, yeah.
What makes this book so enduring is that Malkiel isn't just an academic spouting theories.
Yeah.
He's an economist, a professor at Princeton,
Mm-mm.
and a successful investor himself.
Yeah, he's walked the walk.
He's walked the walk. Okay.
You got it.
So right off the bat,
Okay.
Malkiel tackles a question that I think we've all pondered at some point.
Mm.
What really determines a stock's value?
Mm.
I mean, there are so many opinions out there.
Sure.
It can be overwhelming.
Yeah, absolutely. And Malkiel lays out two contrasting theories to help us understand this. First up is the firm foundation theory, which is all about fundamental analysis.
Okay.
Think of it like inspecting the foundation of a house before you buy it.
Uh-huh.
You're looking at concrete factors like a company's earnings, dividends, assets,
Mm-hmm.
and overall financial health.
Yeah.
Many financial analysts swear by this approach.
So it's the show me the numbers approach.
Yeah,
But Malkiel doesn't stop there right now.
right.
He throws in another theory that's a bit more whimsical.
He does. It's called the castles in the air theory,
Okay.
and it emphasizes the role of market psychology.
Okay.
This theory argues that stock prices aren't always grounded in cold, hard facts.
Yeah.
They can be driven by speculation, emotion trends.
Yeah.
Basically, what people believe a stock is worth,
Uh-huh.
even if it's detached from the company's actual performance.
Okay.
John Maynard Keynes, a famous economist, was a proponent of this idea.
So are we talking about things like the wild ride of cryptocurrency
Yeah.
or those meme stocks that seem to defy all logic?
You hit the nail on the head. Malkiel uses some fascinating historical examples to illustrate how this castles in the air mentality has played out over time.
Okay. I'm all ears. Give me the historical drama.
One of those infamous examples is tulip mania, which gripped the Netherlands in the 17th century.
Okay.
People were obsessed with tulip bulbs,
Uh-huh.
driving prices to absolutely absurd levels.
Yeah.
I mean, we're talking people trading their homes and life savings for a single bulb.
Wow. That sounds almost unbelievable.
It's crazy.
Oh, do people really think tulip bulbs are that valuable?
It's a classic case of speculative frenzy.
Right.
The prices were completely detached from any reasonable measure of value.
Uh-huh.
And of course, the bubble eventually burst,
Yeah.
leaving many people financially devastated.
Right.
But it highlights the power of market psychology and how quickly things can spiral out of control.
So is Malkiel saying we should completely disregard the castles in the air theory? Or is there a balance to be found between these two approaches?
Malkiel acknowledges that both fundamentals and market sentiment play a role in determining stock prices.
Okay.
He advocates for a balanced approach.
Uh-huh.
Don't just chase hype,
Yeah.
but also be aware that market psychology can create opportunities.
Mm-hmm.
Think of it like this. You need a solid foundation for your house,
Okay.
but a little architectural flair never hurts.
That's a great analogy. But speaking of things spiraling out of control,
Yeah.
Malkiel dives into some other historical bubbles, right?
Mm-hmm.
Not just tulips.
Oh, absolutely.
Mm-hmm.
He examines bubbles like the South Sea bubble in 18th century England,
Mm-hmm.
the Roaring Twenties leading up to the Great Depression,
Yeah.
and even the more recent dot-com bubble of the late 90s and early 2000s.
Yeah.
Remember all those internet companies with sky-high valuations, even though they weren't making any money?
Yeah. And then the whole thing came crashing down. So are these bubbles just destined to happen? Is there anything we can do to avoid getting caught in the frenzy?
That's the million-dollar question. Malkiel argues that while we can't predict when bubbles will occur,
Uh-huh.
we can learn to recognize the warning signs.
Okay.
Think excessive optimism.
Yeah.
People throwing money at anything related to the hot trend,
Mm-hmm.
and a disregard for traditional valuation metrics.
Yeah.
It's like everyone's convinced this time it's different.
And that's often a recipe for disaster, right? Didn't Malkiel include some pretty crazy examples of this kind of thinking, like that ZZZZ best scam?
He did. That story of a teenage carpet cleaner who built a fake empire based on bogus contracts perfectly illustrates how deception and greed can fuel these speculative frenzies.
Yeah.
It's a cautionary tale for sure.
Okay, so we've established that bubbles are a recurring feature of markets driven by human psychology. But what can we as investors actually do with that information? How do we avoid getting swept up in the hype and making irrational decisions?
Malkiel offers some valuable insights on that front. But I think it's worth exploring those in the context of his views on whether it's even possible to beat the market.
Right.
After all, if markets are prone to these irrational swings, does that mean we should just give up on trying to outperform the averages?
That's a great question. I mean, we always hear about these legendary investors who consistently beat the market. Is that just luck, or is there some secret sauce they figured out?
Malkiel delves into that very question, exploring various approaches like technical analysis.
Okay.
Think chart patterns and trends, and fundamental analysis, which we discussed earlier.
Right.
But he ultimately makes a compelling case for something called the efficient market hypothesis.
Okay, remind me what that is again. It sounds a bit intimidating.
It's actually quite simple. The efficient market hypothesis states that stock prices already reflect all publicly available information.
Okay.
So unless you have insider knowledge, which is illegal, by the way,
Right.
it's extremely difficult to consistently pick winners or time the market perfectly.
So is he saying that even the pros with all their fancy algorithms and research are just playing a game of chance?
Well, not exactly.
Yeah.
Malkiel acknowledges that there might be some market anomalies, short-term patterns or pricing quirks
Yeah.
that savvy investors can exploit.
Okay.
And he does offer some potentially helpful stock-picking guidelines based on value investing principles.
Yeah.
But overall, his message is that trying to outsmart the market is a risky game, even for the experts.
So if beating the market is so tough, what's the average investor supposed to do?
Right.
Just throw in the towel.
Not at all. This is where Malkiel's advice gets really practical.
Okay.
He's a huge advocate for a core portfolio strategy built around low-cost index funds.
Okay, back up for a second. Why index funds? What makes them so special?
Remember the efficient market hypothesis? Well, if it's true that it's hard to consistently beat the market, why not just join it?
Okay.
Index funds are like baskets of stocks that track a particular market index, like the S&P 500. So instead of trying to pick individual stocks, you're essentially buying a piece of the entire market.
So you're spreading your bets across hundreds of companies, not putting all your eggs in one basket. That's diversification.
Right. Exactly. And that's one of Malkiel's key points.
Sure.
Diversification is crucial for managing risk. He also emphasizes the importance of rebalancing.
Okay.
Let's say you start with a portfolio that's 60% stocks and 40% bonds. Over time, the stock portion might grow faster, throwing your allocation out of whack.
Yeah.
Rebalancing means periodically adjusting your portfolio to maintain your desired mix.
So if my stocks are doing really well, I should actually sell some and buy more bonds to bring things back into balance, even if it feels counterintuitive.
It might feel strange, but it's a smart way to manage risk and ensure your portfolio stays aligned with your long-term goals.
Okay.
And Malkiel also suggests another powerful strategy, dollar-cost averaging.
I've heard of that one. Isn't that where you invest a fixed amount of money at regular intervals, no matter what the market's doing? So even if things are tanking, you just keep buying.
You got it. It might seem counterintuitive to buy when the market's down.
Yeah.
But dollar-cost averaging helps you average out your purchase price over time.
Okay.
You end up buying more shares when prices are low and fewer when they're high.
Right.
It takes the emotion out of investing and can potentially reduce your overall risk.
That sounds like a great strategy for someone like me who tends to get a bit anxious when the market goes haywire.
Yeah.
It's like a built-in discipline mechanism.
Precisely.
Yeah.
And speaking of taking the emotion out of investing, Malkiel also discusses the rise of robo-advisors.
Robo-advisors. Okay, now we're getting futuristic. What are those exactly?
Think of them like automated financial advisors.
Yeah, okay.
They're online platforms that use algorithms to manage your investments based on your goals, risk tolerance, and time horizon.
Okay.
They can handle things like portfolio diversification rebalancing and even a nifty strategy called tax loss harvesting.
Tax long harvesting. That sounds complicated. Is that something I should be worried about?
It's actually not as complex as it sounds.
Okay.
It basically involves selling investments that have lost value to offset capital gains you might have made elsewhere.
Okay.
This can potentially reduce your tax liability, which means more money in your pocket.
Okay, so robo-advisors can help me with that.
Yeah.
Are they like the ultimate set it and forget it solution?
They can be a great option for hands-off investors who prefer a more automated approach and want lower fees.
Right.
But even if you choose to go the DIY route, understanding these strategies is key. Remember, Malkiel isn't just advocating for specific products or techniques. He's emphasizing timeless principles.
Yeah.
Things like diversification, patience, and discipline that are essential for anyone who wants to navigate the market successfully.
Speaking of discipline, one thing that really struck me was Malkiel's discussion of behavioral finance. It's like he's peering into our brains and exposing all the ways we sabotage our own investment success.
He is. It's fascinating, right?
Yeah.
Behavioral finance explores how our emotions and cognitive biases can lead us to make irrational decisions, even when we think we're being perfectly logical.
Okay, give me an example. What kind of biases are we talking about? I'm sure I'm guilty of at least a few.
Well, one common bias is loss aversion.
Okay.
It's this idea that the pain of a loss is felt more strongly than the pleasure of an equivalent gain.
Ooh, that sounds familiar. I definitely feel that way.
Yeah.
Like if I lose $100, it feels way worse than the joy of gaining $100.
Exactly. And because of that, we often make irrational choices.
Right.
Like selling winners too early because we're afraid of losing our profits. Or holding on to losers for too long, hoping they'll bounce back.
I've definitely done both of those things.
I know, me too.
So knowing about these biases is helpful, but how do we actually overcome them?
Yeah.
It's like our brains are wired to work against us.
Awareness is the first step. Malkiel helps us identify these biases so we can start to recognize them in our own behavior.
Okay.
Then it's about putting strategies in place to counteract them. Things like setting clear investment goals, sticking to a predetermined plan, and not checking our portfolio every 5 minutes.
It's like we need to create a system that takes our emotions out of the equation as much as possible.
Exactly. And that's where those principles of patience and discipline come in. Malkiel argues that successful investing is more about temperament than intellect.
Right.
It's about managing our emotions, staying focused on the long term, and not getting swayed by market noise or the latest hot trends.
It's about having a solid plan and sticking to it even when things get a bit bumpy.
Yeah.
Which, let's face it, they inevitably will. But speaking of those bumps in the road, Malkiel delves into some fascinating historical periods of market performance, right? Like different ages of investing.
He does. He talks about the age of comfort, the age of angst, the age of exuberance. It's like a roller coaster ride through the decades. And what's insightful about this analysis is that it shows us how different factors like inflation, interest rates, and even geopolitical events can impact market returns.
Okay.
It's a reminder that even though stocks have historically outperformed other asset classes over the long term,
Right.
there will be periods of volatility and even negative returns.
Okay, so buckle up and prepare for the ride. It's not always going to be smooth sailing.
Right.
But knowing that these ups and downs are a normal part of the market cycle can help us stay the course right.
Absolutely. And that's where Malkiel's emphasis on a long-term perspective comes in.
Yeah.
Don't panic and sell everything when the market takes a dip. Remember, it's about time in the market, not timing the market.
That's a great point. It's so easy to get caught up in the short-term fluctuations and lose sight of the bigger picture. But Malkiel also talks about smart beta funds, right? Those are like a newer twist on the whole index fund concept.
They are. Smart beta funds aim to capture specific market premiums,
Okay.
like value, size, or momentum, while still maintaining a passive approach. Think of them as a sort of hybrid between active and passive investing.
Okay.
They might be a good option for investors who want a slightly more targeted approach than a traditional index fund. But like any investment, it's important to understand the risks and potential downsides before jumping in.
So Malkiel has given us a lot to digest: different investment theories, practical strategies, even insights into our own flawed thinking. But for our listeners who might be feeling overwhelmed, what are the key takeaways from this deep dive? What are the nuggets of wisdom they should carry with them on their own investment journey?
Well, for starters, I think Malkiel really drives home the point that there's no magic formula or get-rich-quick scheme when it comes to investing.
Yeah.
It's about building a solid foundation based on time-tested principles, like diversification, patience, and discipline. Absolutely. It's not about trying to outsmart the market or chase the latest hot stock. It's about making informed decisions, managing risk, and staying focused on your long-term goals. And one of those informed decisions is figuring out your own risk tolerance.
Okay.
Remember, risk and reward go hand in hand if you want the potential for higher returns. You have to be willing to stomach some ups and downs along the way.
So don't bet the farm on something super volatile if you're going to lose sleep every time the market takes a dip.
Exactly. That's why Malkiel spends a lot of time discussing asset allocation, how you divide your investments among different asset classes like stocks, bonds, real estate, and so on. This mix should reflect your individual circumstances, your age, your financial goals, and of course your risk tolerance. And as you get closer to retirement, you probably want to shift to a more conservative approach.
Got it. So start by figuring out how much risk you're comfortable with, then build your portfolio accordingly.
Yeah.
But even with a diversified portfolio, there's still the risk of making emotional decisions right, like selling everything in a panic when the market tanks.
That's why Malkiel stresses the importance of having a plan and sticking to it. Remember his favorite, quote, "The most important quality for an investor is temperament, not intellect." It's not about being the smartest person in the room, but about having the discipline and emotional control to stay the course even when things get tough.
Okay, that's a great reminder. And speaking of reminders, Malkiel is a big fan of index funds, right? For those of us who aren't trying to become professional stock pickers, what's the elevator pitch for why index funds are so great?
They offer a simple and cost-effective way to capture market returns, especially for long-term investors. They're like buying a slice of the entire market pie instead of trying to guess which individual ingredients will perform the best. And remember, even if you do dabble in individual stock picking, indexing, a significant portion of your portfolio can provide a solid foundation.
So even if my high-risk bets don't pan out, I've got that stable base to fall back on. And what about dollar cost averaging? That seems like another strategy that can help take the emotion out of investing.
Absolutely. By consistently investing a fixed amount at regular intervals, you're essentially tuning out the market noise and focusing on the long game. It's a powerful technique for building wealth gradually. Remember, investing is a marathon, not a sprint.
Okay, so I think we've covered a lot of ground here, but what's that final thought you want to leave our listeners with? Something to really ponder as they embark on their own investing adventures.
I think Malkiel sums it up beautifully when he says, "It's not hard to make money in the market. What's hard is to keep from losing it. So stay informed, be patient, make wise choices, and remember, it's a journey. Enjoy the ride."
Wise words. And if you want to dive even deeper into Malkiel's brilliant insights, be sure to check out A Random Walk Down Wall Street. You won't regret it. Until next time, fellow deep divers, keep those brains engaged and happy investing.